In this video, we will walk through the essentials of understanding employee tax deductions in Denmark, so you can better interpret your payslip, plan your finances, and avoid unpleasant surprises at tax time. We will focus on the perspective of an employee, not a business owner, and keep the discussion practical, clear, and aligned with current Danish tax principles. Let us begin with the overall structure of the Danish tax system. As an employee, your income tax is primarily handled through withholding, meaning that your employer automatically deducts tax from your salary before you are paid. This is based on the information in your tax card, which is issued by Skattestyrelsen, the Danish tax agency. Your tax liability is calculated annually, but spread across the year through these monthly withholdings. The core idea is that your taxable income is your salary minus relevant deductions, and those deductions directly influence how much tax you ultimately pay. Many people focus only on the tax rate, but in Denmark, understanding and optimizing deductions is equally important. At a high level, you can think of three main layers: personal allowances, standard deductions, and specific itemized deductions related to work or life circumstances. Let us first clarify the personal allowance. Every taxpayer in Denmark receives a basic personal allowance known as personfradrag. This is a fixed amount of income on which you do not pay tax. You do not need to apply for it. It is built into your tax card and automatically reduces your tax. The size of this allowance can differ between adults and young people under 18, and it is adjusted periodically by law. While you do not actively manage this allowance on a monthly basis, it is helpful to understand that part of your income is shielded from tax from the outset. Beyond this personal allowance, the next most relevant concept is the employment deduction. If you have ordinary employment income, you are entitled to an employment allowance that effectively reduces the taxable portion of your salary. This allowance is calculated automatically as a percentage of your earned income, up to a certain cap. You do not need to submit documentation for it. It is embedded in the tax system and reflected in your preliminary income assessment and in your final tax calculation. For most employees, this employment deduction is the single largest work-related deduction and is already factored in, so the real value lies in understanding the additional deductions you might be missing. One of the key work-related deductions is the deduction for commuting, often referred to as the transport deduction. If you commute more than a certain distance between your home and your workplace, you may be entitled to a deduction based on the number of kilometers you travel each day, calculated at fixed rates set annually by the tax authorities. This deduction is not granted automatically. You must ensure that your commuting distance and days of work are correctly registered in your tax information. Note that the deduction is distance-based, not cost-based. It does not matter if you drive, use public transportation, or cycle. What matters is the number of kilometers between your home and your workplace and how frequently you make the trip. Many employees either overlook this deduction or fail to update it when their workplace or address changes, potentially leaving money on the table. Alongside commuting, another common area is work-related expenses that are not reimbursed by your employer. In Denmark, you may be able to deduct certain professional expenses that are necessary for earning your income, such as specific tools, professional literature, or membership fees for relevant trade unions and unemployment insurance funds. Union membership fees and contributions to an unemployment insurance fund, known as an A-Kasse, are typically deductible up to certain limits and are often reported directly to Skattestyrelsen by the organizations. Still, it is important to verify that the amounts in your tax return match your actual payments. For other job-related expenses, deductibility depends on whether the cost is considered necessary for your work and not reimbursed by your employer. There is also often a minimum threshold for these miscellaneous deductions, meaning you only get a tax benefit for the portion exceeding a certain amount. It is essential to keep documentation such as receipts, invoices, and contracts, in case the tax authorities request evidence. Pension contributions are another central element of the Danish system. If you contribute to a pension scheme through your employer, such as a labor market pension, Those contributions are typically deducted from your salary before tax is calculated, which means they effectively reduce your taxable income. This is a significant advantage, as it allows you to save for retirement with pre-tax money. For certain individual pension schemes, tax treatment can vary depending on whether it is a lifelong annuity, a temporary pension, or a lump sum product. In general, contributions to approved pension schemes are either fully or partly deductible or excluded from immediate taxation, but there are annual caps and specific rules. Employees should review their pension contributions in their annual tax statement to ensure they are recorded correctly and aligned with their long-term saving strategy. Beyond standard employment and pension deductions, there are other personal deductions worth noting. Interest expenses on loans, such as mortgages or certain consumer loans, are often deductible, which indirectly affects your net tax position as an employee. Contributions to approved charities within certain limits can also generate tax deductions. If you own property, real estate taxes and related deductions will influence your overall tax burden, even if they are not strictly employee deductions. Although many of these are reported automatically by banks, mortgage providers, and other institutions, you remain responsible for verifying their accuracy. The Danish tax system relies heavily on pre-filled information, but pre-filled does not necessarily mean correct, especially if your circumstances change. It is therefore good practice to review your preliminary income assessment each year, typically at the end of the calendar year or the beginning of the new year, and to update expected income, commuting distance, pension contributions, and any known deductions. Doing so helps ensure that the tax withheld by your employer aligns closely with your final liability, reducing the risk of an unexpected bill or large refund. Practically, this means logging into the online tax portal, checking that your salary expectations match your contract, confirming your address and workplace for commuting deductions, and reviewing pension and union information. When you receive your annual statement, compare the reported figures with your actual payslips, bank statements, and certificates. If something is missing or incorrect, you can usually correct it online within a defined time frame. A disciplined approach can significantly improve your financial predictability. A frequent question from employees is how much effort it is worth putting into optimizing deductions. In Denmark, marginal tax rates can be relatively high, especially for middle and higher incomes, which means every deductible krone can yield a meaningful tax saving. However, it is important to focus on deductions that are clearly permitted and well documented. Attempting to stretch definitions or include private expenses as work-related costs can backfire in the event of a tax audit. A professional mindset is to understand the rules, claim what you are entitled to, and maintain orderly records. If your personal situation is complex, for example, if you work partially abroad, have multiple employers, or receive stock options and bonuses, you may benefit from seeking tailored tax advice. For most employees, however, the main levers are straightforward. Ensure your commuting deduction is correct, verify union and pension contributions, review interest and charitable deductions, and keep your preliminary income assessment current. Over time, this discipline can translate into thousands of kroner in avoided overpayments and smoother cash flow throughout the year. To conclude, understanding employee tax deductions in Denmark is less about memorizing every rule and more about mastering a few core principles. Know that your employer withholds tax based on your tax card, which incorporates your personal allowance and standard employment deduction. Recognize the additional deductions you can influence, particularly commuting, professional expenses, union and ACASA fees, pension contributions, and interest and charitable deductions. Make a habit of reviewing your tax information annually, using the official online tools and keeping basic documentation. By doing so, you move from being a passive taxpayer to an informed financial decision-maker, better equipped to navigate the Danish system and support your long-term financial goals.